Now, this could also become a multi-part video discussion because in this video, I want to talk about TREPs versus fixed deposits in banks. Now, some of you might not have ever heard of this thing called as TREPs. Some of you might have heard TREPs, but you don't exactly know how it functions. So, this video is important for traders because when the market is in a confirmed downtrend, ideally we are not supposed to take a swing trade or a positional trade. I have discussed this multiple times on this YouTube channel. If you look at William O'Neill's material, he says that 50 to 75% of your portfolio should be in cash when the market is in a confirmed downtrend. I would go one step further and become more conservative and say that almost 100% of the portfolio should be in cash when the market goes into a confirmed downtrend. If you read Mark Minervini's book, in that book, he talks about something called as the 50-80 rule. The 50-80 rule says that leading stocks, with leading stocks, there is a 50% probability that they will fall 80% from the top, and there is a 80% probability that they will fall 50% from the top. And this rule applies to leading stocks. Okay. So that is the reason why I am being ultra conservative. And when the market goes into a confirmed downtrend, most of my portfolio is in cash. Now, please don't consider this video as advice or anything. I am not a registered advisor. I am not a registered research analyst yet. In this video series, I just want to compare fixed deposits and TREPs. And it's a general discussion. I am not going to talk about any product or a fund. It's a general overall discussion to help you manage this portion of your portfolio better, because in a confirmed downtrend, your portfolio is most likely to look like this: 80% cash, 20% exposed to the market, or maybe 100% cash, portfolio exposure 0%. That is even better, so that you protect your unrealized gain. See, in a confirmed downtrend, you might not find yourself losing money if you already have a gain, but you might find yourself losing those unrealized profits very fast as stocks start to break the moving averages. So, this discussion is extremely important. So, pay attention here. When I talk about cash position, I want to discuss three things: the risk involved, the return that we can expect from that portion, and the liquidity that we expect from that portion of the portfolio. See, if I keep that money as cash, as idle in my bank or my broking account, it is not earning me anything, right? So it's a drag on the portfolio. We don't want that position to be a drag on the portfolio. Even you look at people like Warren Buffett, he does have billions of dollars of cash position, but it is not lying idle in the bank. It is generally invested in government securities. Okay. I will come to the definition of TREPs. We will discuss that in detail. I have created some diagrams for you, but I'm just giving you context as to what I'm trying to convey here through this multi-part video series. Again, I don't know how many parts this video series will become. This is just the beginning. Okay, let's go to the next slide. So this is the orange trading system. As you know, the fifth step in doing our stock analysis is market conditions. So when the market conditions are weak, let's say the market conditions are in a confirmed downtrend, we are not allowed to take a swing trade or a positional trade. So majority of our money is sitting in cash. The question is where to put this cash while keeping in mind three factors: risk, return, liquidity. We should not put it in something that is risky. We should expect at least some kind of return from it. It should not be remaining idle, and it should be liquid. Okay, let's go to the next slide. So I have created three blocks here. One is fixed deposits, one is TREPs. I will discuss what are TREPs, and one is gold and silver. Now, gold and silver, Robert Kiyosaki says that it is God's money. He actually goes on to say that gold and silver is God's money, fiat currency is government's money, and cryptocurrency is people's money. Okay, so when I am putting my money in gold and silver, I am not looking at the price of gold and silver. I am just trying to convert my fiat currency into something that is real and tangible and which has maintained value for more than 5,000 years. That is my objective when I'm putting my money in gold and silver. Now, if I take the cash in my trading portfolio and temporarily put it in gold and silver while I'm waiting for the market to come into an uptrend, what is the risk in that? Well, the risk in that situation is while the market is in a confirmed downtrend, my cash is invested in gold and silver. And while I am waiting for the market to recover, during that time, if gold and silver falls, I begin to lose capital, right? So putting that cash in gold and silver like an ETF or a fund of funds or something like that, or a gold fund, that would be very risky, correct? So remember what I said, we have to look at three things: risk, return, and liquidity. So putting my money in gold and silver, that portion would be too risky. So then why am I discussing gold and silver here? What is the need to discuss gold and silver in this part of this video series? The reason is simple. I want to explain to you the concept of counterparty risk. Okay. Unless you understand counterparty risk, you will not understand what is TREPs. Okay. So let us discuss counterparty risk. So let's say Rohit puts some money in a bank in a fixed deposit. Okay. Let's say 25 lakh rupees. In exchange, what does Rohit get? Rohit gets a fixed deposit certificate from the bank. And these days, you don't even get a certificate. You get something like, digital confirmation, maybe an email, or, on your mobile application, you can see how much money is there in a fixed deposit in your bank. Okay. So it's all digital these days. So you are getting digits in exchange for your money, right? You are getting just a promise in exchange for your money. That's fixed deposit. Now, what is the risk in this transaction? Well, the risk is very simple. What if the bank fails? Have you not recently heard stories of people who have made fixed deposits in banks and the bank failed because of some fraud or something, and people had a very hard time getting their money back? Okay. In fact, I have a friend in Navi Mumbai. She put like 8 lakh rupees in some bank. The bank went bankrupt and she lost money and she could not recover all of her money. She got some money. But there are other cases where I have heard that a family put like 5 crore as a fixed deposit in a bank. But in exchange, the deposit that was insured was only 5 lakhs. So you put 5 crore, you get only 5 lakhs. So that's the risk. That is called counterparty risk. In fact, if you go to, let's say, go to Chat GPT and ask how much of our deposit in the bank is insured. Let me ask this question. How much of my deposit in a bank in India is insured? Okay, I'll put question mark. Let us see what Chat GPT tells us. Let's see what is the answer here. See, these days, Chat GPT also takes some time to answer. So let us give it some time. Here it is written, Chat GPT can make mistakes, check important info. See, in India, the Deposit Insurance and Credit Guarantee Corporation insures bank deposits. As per current regulation, the insurance cover only up to 5 lakh per depositor per bank. So which means you go back to this diagram, okay, you can read this in detail. This is an insurance company that insures the deposits that we make in a bank. There are more conditions, okay? But broadly, the idea is if I put, let's say, 25 lakhs as a fixed deposit in a bank and the bank fails, I will get 5 lakhs. If I put 5 crore as FD in a bank and the bank fails, I get only 5 lakhs. It's very simple. That is called as counterparty risk. Now, of course, there are regulations. So the Reserve Bank of India might step in. They might try to recover funds by selling off the assets of the bank or trying to do something to protect the depositors, right? But how long do you think that process will take? How long will it take you to get the money from the Reserve Bank of India or from the whole bank uh, problem resolution process? That is called as counterparty risk. I wanted you to understand counterparty risk because there are a lot of people in India who think that they have made an FD, so the money in the FD is safe. Well, nothing is safe in the financial markets. Everything is risky. Okay. Everywhere there is counterparty risk. Where do you think your money goes when you put your money in a fixed deposit? Where do you think your money goes? Do you think that when you put 25 lakhs in a bank, they have like a cardboard box and in that box they put like 25 lakh rupees cash and they store it for you? No, no. That money goes to entrepreneurs. That money ultimately goes to entrepreneurs, businesses as a loan, and hopefully those entrepreneurs and businesses repay back that money with interest so that the bank can return you back your money with interest. Correct? So when you are making a fixed deposit with a bank, you are lending money to the bank, right? You are the lender, the bank is the borrower. So in a lending borrowing relationship, who do you think is at risk? The lender is at risk because the borrower can default, the borrower can go bankrupt, right? The borrower can fail. So in this case, the bank is the borrower. That is the counterparty risk. Okay. So if you're still thinking that FDs are safe, I challenge that belief. Okay. Please think about it again. Okay. Next. Now let's say Rohit buys some gold. Let's say 1 ounce of gold. 1 ounce is roughly 31.1 grams. Let's say Rohit buys 1 ounce of gold. How much is 1 ounce today? Maybe $3,000. So if I buy 1 ounce of gold from, let's say, a local jewelry shop, I get that 1 ounce gold coin or bar, and that coin or bar is with me. Now you tell me where is the counterparty risk here? Okay. Can gold fail? Because this is not some institution. You are paying money, in return you are getting your gold. So your wealth is with you. In the previous case, your wealth was with the bank. So the bank is in control of your money. Here, you are in control of your money. The only risk here is the risk of theft. Okay. Or maybe risk of losing that gold coin. Maybe you misplace it, you don't find it, or maybe someone steals it from you if you have kept it in an unsafe place. But that's extreme situation. I am saying when you put money in gold to buy a gold coin, let's say 1 ounce, that 1 ounce coin or bar remains with you, your wealth with you. There is no counterparty risk here. If all the banks in the world fail, if all the economic system fails, you still have your gold with you, right? So with gold, there is no counterparty risk involved. Okay. This is the reason why I put gold and silver there, just to help you understand the concept of counterparty risk. Now, I spoke about FD. The same thing applies to cash in the bank. Let's say you have 5 lakh rupees lying idle as cash in the bank. You have not even made an FD. It's a simple savings account. You open your mobile application, it shows 5 lakh rupees. Okay. That is again counterparty risk. What if the bank fails? What if the bank doesn't have money to give you? Right? That is called counterparty risk. So the purpose of this part one video is to help you become aware of counterparty risk. Next is, before I go to TREPS, I want to complete one last explanation and then we will move to part 2 of this video. Let's say you have 25 lakh rupees in your broking account. Okay. And out of 25 lakhs, 20 lakhs is, let's say, invested. So the market is doing well. And you, out of 25 lakhs, you have 20 lakhs in the market. What about that remaining 5 lakhs? Where is that money? That money is lying in the trading account of your broker. Okay. Now tell me, does that have counterparty risk? What if the broker fails? What if the broker goes bankrupt? So somebody asked me this question actually, and I did some research and I found out that SEBI, the regulator, has mandated brokers that there should be a segregation between client's money and the broker's account. So that 5 lakhs that you have with your broker is not in the business account of the broker. It is in a separate client pooled account. Okay. So even if your broker fails, the regulator can access that client pooled account to recover the money and give it back to you. So even if you have some money lying idle in your broking account, uh, the counterparty risk is not there or is relatively less, I would say, compared to a normal fixed deposit. Okay, because it's kept in a separate client pooled account. So you understand, I am discussing with you the risk of keeping cash in the bank. I am discussing with you the risk of keeping a fixed deposit in a bank. I am discussing with you the counterparty risk by buying gold coins or silver coins. I'm also discussing with you the counterparty risk when you keep your money idle with the broker, which is not invested in stocks or mutual funds or anywhere. It's just lying idle with the broker. That money is still better because it is kept in a separate client account. Now, the risk there is if the broker fails and the broker fails to comply with the regulators' uh, regulations and the broker mixes the client funds with the account of the broking firm itself, then there is a problem. Okay, it's a clear case of violation. So if the broker is deliberately doing that, that's a big problem. But in India, thankfully, the regulations have been becoming tighter and tighter. We can reasonably assume that that money is lying properly in a separate client pooled account. That is why the reputation of a broker is extremely important these days. Okay. This is what I wanted to discuss in part 1. Remember, I have not even touched TREPS because I want to do a dedicated video on TREPS. But to understand TREPS, you first need to understand what is counterparty risk. I will simplify TREPS to you in part 2 of this video, but please understand that this video is like a prequel to that important video. You need to understand TREPS because I am making the argument as TREPS. I am making the argument that TREPS is better than a fixed deposit in a bank in terms of risk, return, and liquidity. Return, not so much, but at least the risk and the liquidity. When I say risk, I'm talking counterparty risk because in TREPS, the counterparty risk is almost eliminated. There is negligible counterparty risk. And when we discuss TREPS, you will understand why I discussed counterparty risk in this particular video. So thank you for your patience. Thank you for your time in listening to this video. This is very important for your financial education. Very few people talk about what to do with the cash that is lying idle in your broking account. That money needs to earn something for you. It adds to your return. Even if it makes like 6% per year, that is still some return, right? Which can add to your portfolio return. I will see you in part 2.